Good evening. I'm John Batchelor. This is the John Batchelor Show. Larry Kudlow, my colleague and friend and co-host, joins. Larry had a stimulating colloquy tonight with several extremely well-informed people about the market. We're talking Wall Street. We're talking about the numbers, the 16,000 number you hear on the news, and the Federal Reserve. Ben Bernanke is exiting. Janet Yellen is entering. So Larry had a fun opportunity tonight with Steve Iorio, his colleague, to grade Ben Bernanke on his way out. And this is a chance for me to learn and all of us to talk Fed with a grade. We're familiar with grades. Larry, I won't give away your grade, but I will go to the point of grading Ben Bernanke. The rates are very low. The double-track ambition of the Federal Reserve these last years, unemployment and inflation. There is no inflation, and there's not that much unemployment. So my understanding tonight is the market's going to go higher, but we're not sure that it translates into prosperity or faster growth from Main Street. Is that generally true? Good evening, Larry.
Good evening, John. Yeah, it is. By the way, Steve Leisman was my colleague on the Fed stuff. Jim Uriot is a brilliant.
Thank you. I beg pardon for getting them wrong.
It's an odd story. The Fed is creating all this cash. What they do is in the simplest way, they buy bonds from banks. Banks own a lot of bonds. Fed buys bonds, mostly treasuries, some mortgage bonds, and they pay for it with cash. And now you say, well, where's this cash come from? Well, the answer is they create it out of thin air. That's the beauty of a central bank. So they give the banks the cash, and the Fed takes the bonds. So what do the banks do with the cash? Well, in theory, you want them to loan it out, taking some risk, and get it into the business world where it can multiply and create jobs and create income for families and create wealth. In practice, there is some of that, but most of it is piling up on deposit at the Fed.
$2.5 trillion at the Fed.
Yeah, it's just this pileup of called excess reserves.
Right.
And the Fed is paying them 0.25% on the money. It's 25 basis points, risk-free. And you're really talking just about a handful of banks, 5 or 6 banks. So it's a fair piece of change. And the banks don't have to take a single bit of risk to do this. Now, my argument, not everybody agrees, if the Fed removed that reward for keeping the excess reserves idle, if they took that out, I think the banks would be bolder, and they would try and get a better return and make some loans, be a little, take risks. That's what they're in the business to do, take, good, competent risks. And you'd probably see that move down to Main Street. The banks would, for example, loan money to smaller banks, to community banks, and then community banks would have enough reserves to make more loans to their, local car dealers or whatever it happens.
Isn't that the investments we need in the growing of companies and the hiring of employees and the prosperity growth? That $2.5 trillion would go to GDP.
Well, not precisely, but it would help. It would grease the wheels. I mean, I don't think money really creates jobs. I mean, I think you have to have the right incentive structure, and you have to have regulations that don't interfere with business.
All right, I misspoke. What I mean is that the businesses who hire people, the businesses would grow and would push into the marketplace new ideas and new products, and that would lead perhaps to jobs.
Yeah, I think there's something to that. Like, if you could take away Obamacare, John, you'd have a lot easier.
We're going to do that later on tonight, Larry. I wanted to stay with the market. The market's doing well, and it's comfortable. And before we get to your grade of Mr. Bernanke and Mr. Uriot's grade, the market is at 16,000. You tonight were very careful saying the market's doing well with Mr. Bernanke's decisions. I don't know about Main Street, but the market's doing very well, and that means Janet Yellen, does she see that Mr. Bernanke's decisions are being rewarded? Low interest rate and continuing QE.
Well, yeah, she shares the view. She was one of the creators of this QE,
right,
and the 25 basis points paid on excess reserves. And, of course, she knows full well there's no inflation.
Right.
And she believes, really unlike me, that more money creation will create a lower unemployment rate. And I don't really believe that. I think it's a minimal effect.
That's kind of magical thinking. I just want to stay with the market for a moment.
But that's,
14 looks like 13.
I think it is.
Okay, fine.
Every central bank in the world is doing what
I hear a lot of smiling right now, Larry. So, okay, fine. Yeah, fine. Okay,
and it's good for stocks. And the other thing is, John, companies are profitable.
Yep.
Don't forget that profits are very important, and companies are profitable, and the Fed is providing the juice, and this is going to go on for a while. I don't know how long, but it's going to go on for a while.
One of your informants, you'll say the name correctly, forgive me, all I do is watch you on television, Larry, I don't get the print. One of your informants said, well, there might be some risk because the market isn't responding so giddily to QE and to low interest rates as it did before, but still that's episodic, and the general terrain is for a good 14 for investors because profits will continue.
That's correct. I think so. And you might not get, look, we're up 25% this year on the S&P 500.
Right.
So you might not get 25% next year, but monetary conditions are very favorable for stocks. And as I said, companies are generally quite profitable. In fact, we have record profits, the level of profit. So in a sense, it's like, what's not to like? And I know that there are risks, and people are talking about bubbles out there, but I don't believe it because price-earnings ratios, multiples, are running 15, 16 times. Now, that's
forward earnings.
Yeah,
right?
that's not cheap,
no.
But it's not bad either. And in a bull market, that stuff can run 16, 17, 18, 20 times earnings.
2000, we were 19, 20, 21 in the NASDAQ.
That's correct.
We were, nosebleed territory. All right, now, getting to the grade, just a moment. Where's the inflation, Larry? What happened to it?
Yeah, the Republican Party ran against the Fed creating inflation. There's no inflation. It's less than 1%. And, by the way, commodity prices, commodity indexes,
right,
have actually been falling.
Gold crashed from 1900
to 12 or 1300.
Right.
The dollar has been fairly stable. So all your classic value of money inflation indicators are doing just fine. And so I gave Bernanke a B. Okay, I gave him a B, even though I don't agree with him about QE, because I'd like him to take that 25 basis point reward away. And I don't know how the hell the Fed's going to slim its balance sheet down.
And Jim Iorio, what was his grade for Bernanke?
Well, Leisman also gave him a B.
I see.
Leisman is our economics watcher at CNBC. And he did it for slightly different reasons. He just thinks it's a good policy to put liquidity in. My take is Bernanke was a hero, John, in 2008 and 2009. In other words, QE1 was vital to avoiding a real...
You said tonight he rescued the economy.
And he made emergency loans everywhere. And he deserves enormous credit for taking those actions. I didn't like QE2. I don't like QE3 particularly. But he has kept the inflation rate down, and he has prevented a bubble. There is no bubble going on. And he has that help. And let's face it, lower interest rates have helped the housing market recover. They have helped the auto loan market recover. And those are not small things. Those are important things. So I gave him a strong B, John. That was my grade.
And that's a good grade to get, a gentleman's B. In the old days, we called it gentleman's C, but there's great inflation. I understand. That's where the
central banker of my lifetime was Paul Volcker,
right?
Who I just saw, in fact, at a reception and rode the New York-Washington shuttle with him. Once upon a time, as a young man, I was actually a secretary to Paul Volcker. Anyway, Paul Volcker got the inflation rate down from 15% to 3%, and that was an incredible achievement, which helped rescue the economy. And Ronald Reagan said to him, "Do what you have to do," and it was painful, but it paid off with basically a 20-year boom. So Volcker would get an A, John. And I would give Alan Greenspan a B+, because he kept the inflation rate down, even though he made some mistakes in the early 2000s. So I give Bernanke a B, largely on the strength of his rescue mission back in 2008 and 2009.
All right, we're turning to the F of Obamacare next with Ed Lazier at Hoover Institution. Larry Kudlow, CNBC's Kudlow Reports and Kudlow Radio on the weekend. I'm John Batchelor.